Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today's video is really going to cover two main things that I use to avoid falling into basic kind of beginner mistakes with investing. And really that mistake is if a stock is down 30 or 40 or 50%, I must be getting a 30 or 40 or 50% discount. That's true, you're getting a discount to what you used to be able to buy those shares for, but whether you're getting a true discount to what those shares are fundamentally worth is an entirely different question. So I want to get into the two things that I use to avoid that trap. The first one is just calculating intrinsic value in the first place, and the second one I want to spend a bit of time on is the reason why I prefer to use something called enterprise value when assessing companies, particularly at a time like now, where a lot of the situations have changed for particular businesses, where they've taken on a lot of debt and used up a lot of the cash reserves that they had. So let's get straight into it. Looking at a stock chart and seeing it down 30 or 40 or 50% and thinking, you know, I can really get a bargain on this particular stock right now is a trap that I see many investors fall into. Generally it's happening with beginners, but I even see it with some more advanced investors. I was watching a podcast yesterday with Jeremy from the Financial Education channel and Graham Stephan, and Graham Stephan was talking about along very similar lines. And that's really the reason why I want to get into this video. It's easy to fall into that trap and think that just because something's down 30 or 40%, you're getting a large discount and can make sort of outsized returns moving forward, which is generally not the case. There are often very, very good reasons why stocks go down. And really the main tool that I use to avoid this entire trap is simply just calculating an intrinsic value estimate for that business. When I'm looking at purchasing into a stock, I basically, as you know, have a bit of a checklist that I go through. And the first thing is I need to understand the business. I need to know that it has some sort of competitive advantage, which will allow it to thrive into the future. It has to have good management, and I have to be able to buy it at an attractive price. And basically, when I think about buying the business at an attractive price, typically I'm running some sort of discounted cash flow, and I have videos on the channel doing that. But really I'm trying to assess it a lot like you might assess a real estate investment. So I'm looking at how much cash can this business produce, or how much can I rent this rental property out for, what am I going to have in the way of expenses, and then from that I can figure out how much cash I can sort of take home at the end of each year, and then figure out an appropriate price to pay for that stock or for that rental property or for that farm or whichever kind of asset class it is. You should always have a similar kind of methodology. It's basically, with investing, if I lay out cash today and expect to get some cash back tomorrow, how much cash do I have to lay out today and how much cash am I going to get back tomorrow? That's the basic equation. And really the market price of that house or that stock or whatever it is should be irrelevant to your analysis when you're looking at figuring out what you think something is fundamentally worth. So just because something was up at a certain price at one point doesn't mean it was actually worth that. And things may have changed and the company may have taken on more debt in recent times, which has genuinely pushed the actual underlying value and fundamentals of that business downwards as well. So that's the first thing I do, is I run my own calculations, and largely I try my best to completely ignore current market prices and what the sort of stock chart history kind of looks like. That is a big step that I took relatively early on in my investing life, but it was one that allowed me to avoid a lot of these beginner mistakes and buy something down that's, you know, just because it's down 50% and then, you know, be stuck with something that's falling all the way down further. So that's the first thing I look at. It will allow you to completely avoid just stupid situations like the Hertz situation that's going on at the moment, where Hertz is very, very likely to eventually have its shares worth zero, yet investors are still speculating that it might go up to where it once was. And we've seen the stock 10x and then come back down another 80% and do all sorts of crazy stuff. And essentially, if you're behaving like that in the stock market, you're not investing, you're speculating, and you're gambling. So the second thing I do in situations like this is I use a metric called enterprise value, and I'm going to use a real life example of a company that for whatever reason I like to pick on when it comes to enterprise value, just because they do have a lot of debt. and it makes it very, very clear that the business is not necessarily as cheap as it looks like it is on the surface of things. So for those who don't know, enterprise value is basically the market cap for a particular stock. So if you were to buy all the shares of the entire company at today's price, that would be the market cap. So for Apple, for example, that's something like $1 trillion or so if you were to buy the entire company at current per share prices. So that's the market cap. The way that you get to enterprise value is you take that market cap, you add on all of the debt that that company has. So if Apple also has, say, $100 billion in debt, which it about does, then you would get a $1.1 trillion enterprise value, and then you subtract any cash that that business has. So if Apple has, say, $50 billion in cash matched with its $100 billion in debt, you have a market cap of $1 trillion, you get to $1.1 trillion with adding on the debt, and then you get back down to $1.05 trillion with taking off the cash. You might have noticed that enterprise value is really the metric that I focus on strongly in videos where I've done some sort of valuation. So we recently did a video on New Zealand king salmon, and I was looking at an appropriate enterprise value to pay for New Zealand king salmon rather than looking at the overall business in market cap terms. And really I do that to capture debt and cash and try and build in some of those balance sheet numbers into my overall valuation, and it can really keep you out of a lot of traps, which I'm about to show you with Ford today. I will put up an image of their stock chart year to date, and you'll see that the stock is down about 30% odd. Now, if you're one of these beginner investors that think, Ford was, if it was priced roughly at about what it was worth before the whole lockdown and everything, then I must be able to get these shares at about a 30% discount at the moment. And when you look at it on a per share basis or on a market cap basis, you'll see that as well. And that doesn't necessarily mean that Ford was in and around intrinsic value. I've already talked about that topic. But essentially it looks like you're able to buy shares in Ford for about 30% less than you used to be able to buy them for. Now that's true when you simply look at the per share price and what you would have had to pay a couple of months ago versus what you have to pay today, but it's not necessarily reflective of what you're actually purchasing in that underlying business. So I'm going to put up another chart here of Ford's enterprise value history, and what you'll see is that during the initial sort of panic, the stock price and the enterprise value both came down relatively sort of in sync. But then what happened is Ford, with all of their factory closures and decreases in revenue and so on, were forced to use up a lot of their cash reserves and were forced to take on a lot more debt. And what you'll see is that that debt actually pushes the enterprise value back up a little bit. And you'll see that if we look at the enterprise value of Ford today versus the enterprise value that it was a few months ago, it's only about 8% cheaper than it was right at the start of the year. So on one hand, you have a stock price that is down over 30%, and on the other hand, you have an enterprise value that's down only 8%. And in my mind, that means you're only effectively buying shares in Ford for about 8% less than you could at the start of the year, but you're also buying into all this extra uncertainty with everything that's going on in the world at the moment, and you're also buying into a company that has a larger amount of debt and a higher potential to get into financial distress and all those sorts of things that debt can bring into a company. So that's why I really like to focus on enterprise value. In practice, it does have some other adjustments in there around preferred stock and so on, but really it's largely driven by cash and debt within the business. And to bring it back to a real estate example and kind of explain this as simply as I possibly can, it's a little bit like buying $1 million home. So if you buy $1 million home, and let's just assume you're paying all cash for this deal, the market cap and the enterprise value, if you pay all cash for that home, are both $1 million. Let's then take another example where you can buy that same $1 million home, but when you buy it, you also have to take on, say, $200,000 in debt that is sort of just comes with the house. Let's just say that that's the way it works. The effective price that you're paying if you put in $1 million and you end up owning the house plus $200,000 of debt, the effective price that you're paying is actually $1.2 million. So it's actually more expensive because you're also sort of inheriting this $200,000 of debt. So that's sort of two situations, and if you look at any old company on Yahoo Finance, you'll often see market cap and enterprise value next to each other, and you can get a good handle on how much debt the business has as a result of the sort of difference between those two numbers. So let's take a third example, and let's again take that same $1 million house and say that the market cap or the market price that you literally have to pay is $1 million. But this time, let's say that you don't have to sort of inherit any debt that comes with the house or anything like that. And when you purchase the house and you first walk into that property, in the lounge, there's literally a bag sitting there of $500,000 in cash. Wouldn't that be nice? So you acquire this house for $1 million. You basically get $500,000 back straight away. So in that case, the enterprise value would be only $500,000. So you have this range of three sort of outcomes with all of the market caps of each $1 million. So when you just straight up buy the house, market cap's $1 million. When you buy the house and it comes with some debt, also $1 million. When you buy the house and it comes with some cash, also $1 million. But that's not really reflective of what you're actually outlaying and what you're actually getting back. So the enterprise value of each of those properties is $1 million when you buy it straight up. It's $1.2 million you're effectively paying when you're taking on that 200 grand of debt, and it's only $500,000 you're effectively paying when you get this big bag of cash that's just sitting in the lounge. So that's the reason I like to focus on enterprise value. It can really make things very, very clear with what you're fundamentally acquiring when you purchase into a stock, because when you do buy a stock, you are buying the debt and you're buying the cash as well as the underlying business. But that's all from me today. I do hope you enjoyed the video. If you want to watch some older videos, you can do so over there. You can hit subscribe over there if you haven't already. We are getting very, very close to 10,000 subscribers, which is very exciting. I'll do some sort of giveaway once we get there, so definitely stick around for that. But that's all from me today. I hope you enjoyed the video, and I will see you in the next one. Cheers.